Hey everyone, my name is Eric Sunheim. I'm a principal and CEO at Mercovis Valuations, and this is a presentation I've given many times in the San Francisco Bay Area to other B2B service providers. And after giving the presentation, many folks have asked me, is this available online somewhere? Well, now it is. So the purpose behind this presentation really stems from me going to networking events and telling people I author appraisals, and they say, oh, you do valuation. Is that like for M&A or something? And if you're an advisor to a company, you definitely need to stick to your own lane, but you also need to know what's going on in these other lanes. And if that's all you know about valuation, you're missing a lot, because valuation is an integral part of tax, accounting, legal issues, insurance. So this presentation will hopefully inform you about how valuation is involved in those areas. To start off, I'll give you some of my background and why I'm qualified to talk about this. I am credentialed as an accredited senior appraiser by the American Society of Appraisers. So when people think about getting a valuation done, I think their first stop is usually their tax preparer. I don't prepare taxes, and the other appraisers I know don't prepare taxes. It's a different discipline, and usually if you're looking for someone to provide a business valuation, you want to find somebody that specializes in this field. So I've been appointed as an expert witness by California judges. I have an IRS security clearance. I've provided expert testimony before the SEC. I've been published in the Business Valuation Review. I have courses that are provided by Business Valuation Resources and Forbes. These are the kinds of things you'd expect to see from a professional appraiser who's going to put together a good work product and defend that work product before a potentially adverse third party. So as we talk about these next 7 subject areas, the first place to start is with an understanding that there's no such thing as a valuation. Valuations are not fungible. They're put together as of a specific point in time. We call that the valuation date. They're put together for the valuation of a specific thing. That could be common stock, it could be equity, it could be the business enterprise, a security like convertible debt or safes. So there's not such a thing as a company valuation. And the purpose of that valuation could inform the number. So even if we're talking about the same security as of the same date, if I'm doing something for tax purposes versus investment purposes, I might get a very different value. So it's important to understand that just because you have a valuation for tax, that doesn't mean you can use that value for your divorce, because among other things, the appraiser is not going to defend it for that purpose. So we have a valuation is usually something that I hear that's a starting point for a conversation and not an ending point. So yes, we do valuation in the context of M&A, but it's not frequently the way that most people think about it. So if a company is going to enter in a transaction, it's the board of directors that makes that decision. And you might have a board member that was the lead investor in your Series B, and you think of them as the Series B director. Well, that Series B director has a duty not just to themselves and the other holders of Series B, but to the holders of all interests in the company. And in satisfying that fiduciary duty, they frequently seek a third-party opinion of value to show that they're not behaving in any type of self-dealing efforts. So there might be a transaction that's very good for that Series B class that results in no value to common. And if that happens, look out for being sued by the common shareholders. So something like this happened in this court case, Smith versus Van Gorkum. And the court found that the board did not satisfy its fiduciary duties, and it specifically pointed out, had they obtained one of these fairness opinions, they might not have been liable. So this was a calling card for everybody to go then get fairness opinions. And the SEC has made a similar comment regarding continuation funds. So fund managers are compensated on the value of their portfolio. And when they establish a continuation fund, want to make sure that they're not getting some undue compensation as a result of these values. So they could seek a fairness opinion with regards to that as well. So anytime there's a transaction of any size where the board is going to opine on a value, then it's a good time for them to talk to someone like Mercovis about getting a fairness opinion. So we're here in the San Francisco Bay Area, and in the Bay Area, cash for companies is like water in the desert. Very hard to come by. But equity is like sand in the desert. They're happy to give it away. So many employees get equity as part of their compensation package. So an engineer might get RSUs or incentive stock options. These are all taxable. So just like when you receive cash, you have to pay taxes on it. Stock, options, cryptocurrency, these are all things that require a value to then know how much tax is owed on them. You might also need a value in setting the terms of that compensation as well. So for stock options, we want the strike price of those options to be at or above the fair market value of the security into which they're exercising. Well, for that, we obtain this 409A valuation. This is not just a tax issue, it's also an issue for accounting. So you're going to have a line item on your P&L if you're issuing stock-based compensation, called stock-based compensation, SBC. And your audit firm, when they look at that line, they're not allowed to opine on what the value of your stock is because they're conflicted out of that work. But they're also not supposed to just accept whatever you say it is. So they have to test the assumptions behind the company's valuation. So know that if a company is granting stock-based compensation for both tax and accounting reasons, they're going to want to obtain a third-party valuation. Another thing we've run into a lot are spin-offs. So companies have been hatching this egg, and when they crack it open, they realize actually there's two businesses in here. Maybe we've been developing a service product, and in conjunction with that, we develop some software. And that has applications well beyond just this service business. It could have applications to other industries. And hey, we have a whole set of different investors that are interested in funding that. So we might see a company spin off or split off those assets into a new entity and create two businesses. There are many ways to affect that. There are very many different tax consequences depending on how that's structured. But in any event, you're going to need a basis in the new entity. So just like when you purchase stock from Vanguard and maybe you buy Amazon stock, well, the price on that day that you bought it, that sets the basis for that stock purchase. And we need to know the basis in your new entity that you hold that's been spun off. So if you hear a company say, we realize there's two businesses, know that they're probably going to need a valuation for that. Another time we might get brought in is after an acquisition has taken place. So you might wonder, well, after an acquisition, hasn't the price already been set? Yes, but there's going to be some accounting that needs to happen with regards to that acquisition. And it's not even always clear what the price was in that acquisition. If that acquisition included both cash and stock, or there's some sort of earnout, what we call the purchase consideration, that's debatable. So companies will obtain third-party valuations, which are called purchase price allocations, to allocate the purchase price into various categories of assets on the balance sheet. So working capital, property, plant, and equipment, yes, but there's also different categories of intangible assets. That could include developed technology, in-process R&D, customer relationships, goodwill. So companies will seek a third-party purchase price allocation to help account for this purchase even after it's taken place. So if you hear we bought another company, that's a good time to refer them to Mercovis. All right, now we get into estate and gift transfers. So around Series D for these tech companies, we start to see executives get rich on paper. And they know they're going to be even richer in terms of cash once there's an IPO or acquisition a couple years from now. So this is a good time to do some estate planning. And we'll often see executives make gifts to irrevocable trusts. And that gift is probably going to be at a lower value than what that stock ends up being in the future when the company goes public. But they do need to know exactly what that value is to report on their gift taxes and estate exemption. So anytime there's a transfer like that, that person's going to obtain a valuation They're even going to get a valuation if it's done for charitable purposes. Anytime there's a tax deduction claimed on property that's worth more than $5,000, the IRS requires the taxpayer to obtain a third-party valuation to establish what that valuation is and substantiate it. So if you hear somebody say, our CEO is making a gift, whether that's a charitable gift or an estate type gift, know they're going to need a valuation. All right, so the last one, you might have to generate these words yourselves, and that is, do you have a buy-sell agreement? A buy-sell agreement is probably the most important document for small businesses with simple ownership structures. By simple ownership, I mean 2 owners 50-50, or 3 owners 1/3, 1/3, 1/3. And a lot of times, these owners have more foresight and hair pulling over fear about their personal relationships than they do their business relationships. So we've had executives that they have prenuptial agreements, but they don't have buy-sell agreements. Well, just like things can go wrong in personal relationships, they can go wrong in business relationships too. And if there's a falling out, you want to know how things are going to be handled efficiently ahead of time. So one reason to get that would be the buy-sell agreement. Another reason to get the buy-sell agreement would be in the untimely death of one of your partners. Maybe you have a partner that you've worked with for 10 years and you don't want that 50% of your business going to that person's spouse when they pass, because that spouse may not know anything about the business. So you want to be able to repurchase that interest while fairly compensating that spouse. So a buy-sell agreement can account for all that before there's a problem. So it's nice to come to an agreement when everybody's sitting on the same side of the table. Now, the way these are typically structured, it's almost like a full employment provision for the appraisal profession, because they say, well, one party should get a valuation, the other party should get another valuation, and if those two numbers are more than 10% off, then we'll get a third valuation. That's great for us as a profession, but I don't think it's great for the clients. And there's better ways to structure that. So we've been called in to quarterback how we should structure these buy-sell provisions, how we should fund them. And if you hear anybody saying, we're getting a buy-sell, or you're asking them, do you have a buy-sell? And they say no, that's a good time to bring in Mercovis. So that's my quick overview of the different types of work that we can do. Please reach out to me with any questions you have. Here's our contact information. Again, I'm Eric Sondheim, Principal and CEO with Mercovis Valuations. Thanks so much for your time.